You've probably noticed it by now. Your groceries cost more, your rent just went up. Even that coffee you grab on the way to work somehow costs 50 cents more than last month. You work harder, you make more money, but it feels like you're falling behind anyway. And the truth is, you are. But not in the way you think. Because inflation isn't just about rising prices, it's about power. It's about who wins when your dollar loses value and who quietly gets richer every time you open your wallet. Most people think inflation just happens. Like weather. Prices go up, that's life. But what if I told you inflation isn't just a side effect of the economy? It's one of the most engineered financial forces in the modern world. A system that, by design or by accident, transfers wealth from you to someone else. And the shocking part is, it's not the people you think. So today, we're going to break this down, not with jargon, but with reality. Who actually benefits when inflation rises? Who pays the real cost? And how does this quiet, invisible force shape the world you live in, from your grocery bill, to your home loan, to your entire sense of financial security? Let's start with something simple, what inflation really is. Most people define it as rising prices. But that's just the surface. In truth, inflation means your money is losing value. The same dollar buys you less tomorrow than it does today. And that tiny, almost invisible loss, multiplied by millions of people every day, becomes one of the most powerful redistributive forces on the planet. Now, moderate inflation, say 2% a year, is normal. Economists even say it's good. It keeps deflation away, helps borrowers, and gives the system a sense of motion. But when inflation runs hot, when it jumps to 6, 8, 9% or more, everything changes. It stops being a tool of growth and becomes a weapon of inequality. Because not all inflation is created equal. There's demand inflation, when people buy more than the system can produce. There's supply inflation, when things like oil or food get more expensive due to global shocks. And then there's monetary inflation, when central banks flood the system with money. Each type hits people differently. Oil shocks, for instance, crush the poor. They spend more of their income on fuel and utilities. But when inflation comes from monetary policy, low interest rates, easy credit, it actually benefits the wealthy because they own the assets that get inflated. Stocks, real estate, corporate shares. Your paycheck might rise a little, but their portfolios explode. That's the part no one tells you. Inflation doesn't hit everyone equally. When central banks cut rates, it's like throwing gasoline on the stock market. Housing prices surge, investments climb, and suddenly, the people who already have assets see their net worth skyrocket. Meanwhile, people trying to buy those assets, young professionals, middle-class families get priced out. That's why when inflation spikes, wealth inequality widens. The rich don't feel it the same way. They own the houses that rise in value. They own the stocks that gain. They borrow cheap money to buy more. The middle class, they just pay more rent. And here's where it gets darker. Because when you look at the data, like the Stanford policy brief on who is most affected by inflation, you see a brutal truth. Inflation is not one single event. It's a series of shocks, and depending on what causes it, it decides who bleeds and who profits. Let's take two examples, an oil shock and a monetary shock. When oil prices spike, say due to war or supply disruptions, it's the working class that gets hammered. Fuel prices rise, transportation costs go up, groceries get more expensive, electricity bills soar. You can't avoid it. You have to drive, you have to eat, you have to heat your home. For these households, inflation is a tax, a silent tax that takes without asking. But when inflation comes from monetary expansion, when central banks lower interest rates and flood the market with liquidity, the damage shifts. Suddenly, it's the asset buyers who suffer. The rich see their bond yields drop, their returns shrink, and their portfolios get squeezed. But the poor, they don't lose as much because they don't own the assets that fall. They just deal with slightly higher prices. Annoying, yes, but survivable. That's the twisted irony. Inflation is supposed to be a great equalizer. In theory, it devalues debt, helping borrowers over lenders. But in practice, it's the opposite. It magnifies inequality, because those with capital know how to protect it. They move it into real estate, commodities, equities, things that grow as the currency falls. The rest just watch their savings dissolve. Think about it. When inflation hits 8% and your bank gives you 2% interest, your money loses 6% of its value every year. That's not just a number, that's your time, your work, your hours of life being devalued in real time. You save, you plan, you trust the system, and the system quietly drains you. Now you might ask, why don't wages rise with prices? Shouldn't that even things out? In theory, yes, but wages are sticky. Employers resist raising pay as fast as prices rise. And by the time adjustments come, inflation has already done its damage. That's why the real winners are those whose income isn't fixed. Business owners, investors, people whose earnings scale with prices. And let's talk about debt, because inflation plays both sides of that coin. If you owe money on a fixed rate loan, inflation is your friend. It makes your debt cheaper over time. You pay back tomorrow with money that's worth less than it was when you borrowed it. That's why governments and corporations love inflation. They're the biggest borrowers in the world. Every point of inflation quietly erases billions in real debt value. But if you're a saver, if you rely on fixed income or pensions, you lose. Retirees on fixed payments watch their standard of living shrink month after month. So who's really winning? Real estate owners, commodity investors, governments, people with fixed-rate loans and tangible assets. Who's losing? Renters, wage earners, savers, pensioners. It's not just a financial shift, it's a social one. Inflation redistributes wealth upward, invisibly. It rewards risk and punishes stability. It tells the young couple saving for a home, you waited too long. It tells the retiree, your lifetime of savings isn't enough anymore. It tells the average worker, run faster, but the treadmill just sped up again. And it's not just numbers, it's psychology. Inflation changes how people think. It erodes trust. When prices keep rising, people stop believing in the system. They stop saving. They start spending faster. Because what's the point in saving if your money's losing value? Economists call it velocity. People call it panic. And once that mindset sets in, inflation feeds on itself. People demand higher wages to keep up. Businesses raise prices to cover costs. The spiral continues. Now you might be wondering, can inflation ever be good? Yes, but only in small doses. A gentle 2% keeps the economy flexible. It prevents deflation, a far worse monster, where prices fall and no one spends. Deflation kills jobs, stalls growth, and traps economies in stagnation. That's why the Federal Reserve wants some inflation. It greases the wheels. But the problem is control. Once it runs hot, it's like fire. It doesn't burn evenly, and it rarely stops where you want it to. History has seen this movie before. The 1970s in the US, stagflation, when inflation soared above 13%. Unemployment hit double digits. Mortgage rates above 20%. The cure? Brutal rate hikes by Paul Volcker, which crushed inflation but also crushed millions of jobs. Inflation is like a virus. Once it spreads, the treatment can hurt more than the disease. And yet, even with all this, governments still quietly prefer some inflation, because it makes their massive debts easier to bear. It's a way to tax the public without passing a law. Your paycheck stays the same, but your power to buy falls, and the gap quietly fills the government's balance sheet. Now let's zoom out. Inflation isn't just numbers on a screen, it's a reflection of how the system allocates opportunity. When central banks print, when rates fall, when liquidity floods markets, who gets that money first? Banks, corporations, investors. By the time it trickles down to you, prices have already adjusted. You're the last in line, paying the markup for their early access. The rich don't fear inflation, they plan around it. They buy scarce things, land, energy, art, equity. The poor just buy what they need. Food, rent, gas. So while inflation might erode currency, it actually concentrates value in the hands of those who already own assets. But here's something most people miss. Inflation isn't just about prices, it's about time. Inflation steals the future. When your money loses value, your goals drift further away. That house you were saving for, now it costs more. The retirement fund you planned, now it needs to double. Inflation makes you think you're standing still while you're actually moving backward. That's the shocking truth. Inflation doesn't just change your finances, it changes your behavior, your mindset, even your morality. When saving is punished and spending is rewarded, people stop thinking long term. They stop trusting promises. They start looking for shortcuts. And that changes entire societies. Look at countries that have faced runaway inflation. Argentina, Turkey, Venezuela. People don't just lose money, they lose trust in money itself. And when that happens, everything unravels. So what can you do? You can't control inflation, but you can understand it. You can protect yourself by thinking like the people who benefit from it. Own assets. Avoid holding too much cash. Understand that money is just a tool, and tools wear out if you don't use them. Inflation is a thief, yes, but it's also a teacher. It teaches you the value of value itself, the difference between what's real and what's just paper. Because the truth is, inflation isn't new, it's ancient. It's been part of every empire, every collapse, every boom. The Romans did it by diluting silver in their coins. We do it by printing digital dollars. The method changes, the result doesn't. And if you take one thing from this video, let it be this: inflation is not an accident. It's a signal. Watch the next video and see how the people who understand where the money's moving next always win. And if you're serious about staying ahead of that shift, hit subscribe. You'll want to see what's coming next. Oh, and if you're thinking of starting your own investing journey, take a look at the link in the description. It's the platform I personally use to explore global markets.